All right, let's get going here. I know there's a bunch of people logged on, and we hope that a few more people get logged on over the next few minutes. But I just wanted to get a quick welcome going. So thanks everyone for joining. I was looking at everyone who joined, and I noticed that we have people coming from across the country. We have real estate professionals, finance and banking professionals, government officials, and experts across multiple asset classes. And we also have students here today. My name is Evan Kinne. I'm a current board member of the UCLA REAG Alumni Group and UCLA Ziman Center Endowment Circle member. I work as a real estate capital advisor at George Smith Partners here in Los Angeles. On behalf of Natalie Greenberg, the current REAG president, and the greater REAG board, we are honored to have each of you here today. And we thank you all for joining us for this speaker series with Tom Barrack and Eric Sussman. For those of you who are unfamiliar with the UCLA Real Estate Alumni Group, or REAG, we're a non-for-profit, volunteer-run organization that works closely with the UCLA Ziman Center. Our membership is open to any UCLA graduate, and if there are any Bruins listening today, we'd love to have you reach out and join us. REAG hosts events both for UCLA alumni and for current students. We help students with interview prep, and we teach students about the various opportunities available within real estate and finance. We hope that everyone listening today will look to hire a Bruin next time they have a job opening. Before we get started today, I'd just like to thank a couple of people. First off, we're grateful to the Ziman Center for their support and their support of excellence at UCLA. I'd specifically like to thank Peter Safana from the Ziman Center and REAG for all their help in organizing this event. I'd also like to thank my firm, George Smith Partners, for helping us get this event on the air today. And importantly, and finally, I'd like to thank our sponsors, Dan Horowitz, Juniper Square, and CGS3. Our moderator today is Professor Eric Sussman. Eric has been a professor at UCLA Anderson's Graduate School of Management since 1995, where he has been voted Outstanding Professor 15 times by NBA students. Additionally, he has been named as one of the top 10 most popular business professors by Bloomberg Business Week, and one of the top 20 most influential professors alive today. Eric is a founding partner at Clear Capital, a real estate investment firm, and oversees the firm's capital, equity, debt, and strategic planning functions. Eric's past experience is broad and varied and includes key positions at Amber Capital and Sequoia Real Estate Partners. On a personal note, I somehow survived a couple of Eric's classes when I was an MBA student at UCLA Anderson. And I will say, Eric, you were influential in kind of guiding me in my career path, so I appreciate that. Our featured guest today is Mr. Tom Barrack. Tom is the founder, executive chairman, and chief executive officer of Colony Capital. Prior to founding Colony Capital in 1991, Tom was a principal with the Robert M. Bass Group. Mr. Barrack also served in the Reagan administration as the Deputy Undersecretary of the Department of the Interior. Throughout his career, he has served a number of high-profile business leadership posts, including serving as the co-chairman of the Board of Trustees of Colony Starwood Homes. Additionally, he sat on a number of public boards, including the boards of First Republic Bank, Carrefour SA, Challenger Financial Services Group, Accor SA, and Continental Airlines. Mr. Barrack received a Bachelor of Arts degree in 1969 from the University of Southern California and a Juris Doctor in 1972 from the University of San Diego. Before I turn the floor over to Eric, I'd like to comment on the format of today's webinar. Throughout the webinar, you will have the Zoom Q&A feature will be turned on and live. So please use that function to post questions that you'd like to ask of Tom and Eric. There's an upvote feature within Zoom. So if there's a question that you see that you like, please go ahead and upvote that question, and it'll kind of rise to the top. And during the last 10, so whatever minutes we have at the end, I'll bring those questions to the attention of Professor Sussman and Mr. Barrack. So I see also, even just in the last couple minutes while I've been talking here, I've gotten dozens of questions emailed to me. So I'll go through those as well. and we can ask some of those too. So I appreciate it. So Eric, you're on the floor.
Well, great. Thank you, Evan. That was a very kind introduction. I hope my My mother is listening. She'll be very proud of that.
Okay, good.
And again, I'd like to also, again, express my welcome to everybody and my thanks to Tom for participating. I thought what would make sense is just starting to frame our discussion. And Tom, you've been very prolific of late with some of your writing, and I hope, and your other interviews that you've done, and I hope everyone's had a chance to read some of Tom's missives. Tom, I thought it would help to sort of frame the discussion. We've got a lot of people from different backgrounds in the industry and even some students on board, and I think they're very familiar with sort of the traditional debt markets in real estate, but maybe not so much with what's happened in terms of mortgage REITs and private debt funds since the financial crisis and Dodd-Frank and all of that. So I thought it would be helpful, just take a few minutes for you to sort of frame the issues you see it, the challenges, again, specific to, again, these alternative debt providers and mortgage REIT and private debt funds.
Great, thanks, Eric. And it's always a little bit frightening sitting on the other side of a summa cum laude professor, but
from UCLA, no less.
I'm gonna march through it. And hi, everybody. I hope everybody's safe and sound and getting used to the quarantine communication that we all have. Let me start from 45,000 feet, and then we can go wherever you want to go. So if you just took the real estate market in general today, we're looking at kind of an $18 trillion marketplace in the US. When we take CRE asset value and start taking it apart in two pieces, and I'm going to go back to 2008. So you have private equity and private debt, and real estate was born out of private equity and private debt. Why? Because real estate as a covariant to everything else, which is why institutions originally started really looking at it in mass, had great characteristics because it was illiquid. So in a volatile marketplace, real estate reacted better, quite simply because you can't sell it in a bad marketplace. In the 70s, REITs started to be envisioned but weren't very popular. In the 80s, we went into a savings and loan flurry where savings and loan sponsors were utilizing federally insured deposits to leverage up real estate development, real estate ownership, and speculative real estate projects. And we had the RTC, which really was the beginning of a new regulatory environment, which became really effective. So fast forward from 1990 and one set of reforms to 2008 and another set of reforms, the banking industry as a prime supplier of debt product to the real estate business cured itself. So today you have an ebullient and really efficient FDIC. Jelena McWilliams and her staff that run it are first class. You have Jay Clayton at the SEC. You have Joe Otting at OCC, and you have 10 regulatory agencies that are monitoring the disbursement of normal banking debt. And the users of that, all of us in the marketplace who are weaving this tapestry of what is the real estate market, have gotten used to lower loan to values, higher debt service coverage, and a more conservative environment. But what happened after 2008 is another set of capital requirements and regulatory confines came on the banking industry, which gave them incentive to not lend aggressively to that commercial mortgage market. So these non-bank banks, so to speak, grew up, supplying that mortgage debt to primarily the non-investment grade market. So an easy way to take this apart to me is if you looked at public debt and public equity. On the public debt side, at the end of the day, you've got maybe 1.7 trillion in active commercial traded debt. Add another 2.3 trillion in private debt. So life companies, banks, endowments, the beneficiaries of which are the 401k providers, have about 2.3 trillion in private debt against 12 trillion of private equity. So what we're talking about as we go to this, what's this tier that banks aren't serving? CMBS, so the securitization of debt, which was the attempt to create liquidity in an illiquid environment, right? The benefit of real estate always was that it was stable in a volatile environment, and we've taken this illiquid asset class of real estate and created liquidity by creating a securitized marketplace with rating agencies that since 2008 in Dodd-Frank, by the way, became much better, much more significant levels of credit enhancement or equity on top of it, and a traded marketplace that every hour of every day you could get a price on tranches from investment grade, AAA, to B, and investment grade being this nomenclature that we call AAA to BBB minus. And that's not just in CMBS. So let me depart for a minute and stop me whenever I start waxing too poetic here.
Okay.
So let's take CMBS. CMBS is 500 billion or so, 500 to 600 billion of the marketplace that we're talking about. But this entire asset-backed securitized marketplace and liquidity into the less than investment grade marketplace, right? Most of what we're talking about today, most of the viewers that are here today are servicing 72% of the GDP of America, which is non-investment grade. So it's the small and middle-sized enterprises, it's the little businesses, it's all of the services, the real estate services around that are not investment grade and can't access the capital markets at an investment grade level.
Well, okay, Todd, just to be clear. So look, and that was a helpful sort of history of what's happened with regulations, certainly going back to the old RTC days, which is probably dating some of us on this call. But I just want to be clear and get your thoughts. So this growth in private debt funds, private debt market, and mortgage REITs, really, in your view, is that, again, it's sort of a maybe unintended, maybe it was intended consequence of Dodd-Frank and and the regulations put on our traditional debt sources as a result of the financial crisis? Is that a fair perspective?
Yes, I think it was intended. It was rightly intended by the regulators to ensure the fact that banks that are normally leveraged 10 to 1, so if you took tier 1 capital, right, keeping them within their capital requirements, and this litany of very complicated capital charges against their proliferation of loans created an opportunity for a third party to create more equity on top of what that bank would normally loan. So part of what we talk about in mark-to-market and repo debt is just these shadow banks are providing additional equity level to the bank, because the bank then ends up doing repo lines to these lenders. Right? Looking through to the same security. The only thing is they have another 20% equity on top. So I think it served, unlike 2008, this phenomenon did not come out of a lack of regulatory intellect or discipline. The regulatory intellect and discipline is first class. It came out of this temporary impairment, this governmental intervention, which is a taking, right? I mean, when you listen to kind of our universe of people are saying, well, wait a second, does the government have the right to take my restaurant? Do they have the right to take my car wash? Do they have the right to stop me from opening my cafe? I mean, it's an interesting question. A year down the line, we'll have another discussion about it. But that temporary impairment to liquidity was not a temporary impairment to credit. So the banks are fine. And by the way, they're borrowing at 0%.
Yeah. No, we both agree that the traditional lenders' financial statements and balance sheets are not the issue this go around. again, maybe just to help educate some folks that may not be aware of the sort of mark to market. And again, I happen to be a professor of accounting and real estate, so I've hedged my bets. But talk about this mark to market thing and this temporary impairment, because that's an area in my other world of accounting. But then, of course, now in this case, it's manifesting itself in what we're seeing in these private debt markets. And it's sort of one of the things you've written about is you've promoted a suspension of mark-to-market accounting. Maybe just talk a little about that and why you think that would be, again, some regulatory reform or relief that would actually help out.
Right. This is a dangerous conversation to have with a professor of accounting, but I'll go down that road.
I'm just asking the questions. I get to listen. It's great.
And by the way, I've had this discussion with the SEC, who were terrific in explaining to me that you cannot change rules in the middle of a crisis because the rules were invented for a crisis, right? So I start there. I get it. However, here's the situation. So if you took this marketplace, if you just took CMBS, right? So that's a traded security, and there's a market for it mostly every day. And that marketplace is the fuel, is the secondary marketplace that funnels most of this non-investment grade universe, not only for real estate, but for credit cards, automobiles, student loans, all of the other non-investment grade stuff. And there's a series of accounting rules, FASB rules, that require you to mark those assets to market based on a protocol, that protocol being some semblance of a market which they're reflecting. And you write up or down those assets depending on who you are. And if you're a financial institution, you have a capital charge that's associated with keeping that, and an easy way to think of it is loan to value ratio, right? So if the value of those securities deplete and they're lending to me, I have to post more cash to keep that lending exactly where it was. And that's the benefit and the detriment. At a time like this, what's happened, and by the way, that happens on CLOs, so collateralized loan obligations separate from CMBS, and in CMBS. So at a time like this, what happens is there is no market. So those tranches of securities that are normally bought and sold by primary dealers, and the circular event of having a market in those creates the liquidity in that secondary market. But when it temporarily stops, and of course it stopped because the collectors are not collecting rent. So you saw today, for instance, a third of everybody that lives in an apartment is not paying their rent. So you have multifamily non-agency securities, you have a problem because that fuel is not coming into the system. As a consequence, those securities end up having another accounting FASB rule, which is the anticipation of a default. And you go from trading at spreads or haircuts. In the parlance of securities, a haircut or a spread. So if you were trading at par, it's par, or if there's some diminution in value, it trades at 10 basis points off par. I mean, you have some of these securities trading at 2,000 basis points off par because there's an ask and there's just literally no bids. So when that happens, besides the securities themselves being diminished in value, the suppliers or the coordinators or the creators of all of those securities who have then leveraged their own positions in order to keep the money flowing. Now, let me just stop for a second and say, am I selling my own billing? Of course, in a way, because all of us in the alternative asset world, or all of us in the private equity world, or all of us in the REIT world are relying on the circular flow of funds for everybody. But the beneficiaries of what I'm talking about are not the big guys. It's the little people. Because what happens is the users of the capital on one side, so the borrowers, when we go into this mark to market, are mostly small and middle-sized enterprises. It's the 62% of America that are not investment grade. On the other side, Who are the bondholders? The bondholders are the same. So the bondholders are primarily insurance companies who are meeting an actuarial hurdle, endowments, ETFs, mutual funds, 401k plans, right? That have bought a bond trying to get some yield that's just better than treasuries. So the argument on this mark to market is, yes, you cannot change a rule just because you have a crisis. It's the free market system, it's capitalism. Those that were more leveraged, who were gleaning the benefit of that leverage, should also have the detriment of that leverage. That's an interesting argument in any case other than where the government, who's the proliferator of these rules, is the cause of the diminution in the income stream. So if you were looking at this another way, which I think it's going to end up, forget about politics, because it's very difficult for any of us normal people to understand the complexity of the political environment. And by the way, I have great respect for all of them. As I said, the regulatory environment is super solid here. That's not the problem. And Congress, in 18 days, did what in 2007 it took 18 months. So they're doing a great job. But when you look at trying to pick winners and losers here, it's an impossibility, right? Somebody is going to be upset. So my suggestion was, look, that the GDP of America is 5.7 trillion a quarter. It's 5.7 trillion. You're already in 2.5 trillion. I guarantee you by the time this is over, with Bill 3, 4, and 5, they're going to be north of 10 trillion. So instead of picking winners and losers, have a timeout for everybody. Say, great, we, the federal government, are going to back the GDP. We're going to back 5.7 trillion to everybody for 90 days.
Tom, what does that look like? So I'm going to either promote you or demote you. Congratulations, you are now a member of Congress. All right, and you're an independent, so we can, so dispense with some of the politics. You said, it's going to be 10 trillion. Obviously, you've been a supporter of CARES. You certainly are in favor of suspending mark-to-market accounting. I get that. Tell me, you're now sponsoring a bill. So you're sitting in Congress, you're sponsoring one of these bills. Give us your top, 5, 10, I don't know if it's me, David Letterman 10, but just bullet point enumerate for us. What does that, in your mind, Tom Barrack's view, what's in that bill with as much specificity as you can sort of give all of us?
Yeah, and by the way, I'm proffering a personal point of view with great respect to all of them, because they know a lot more than I do. But sitting in the trenches, having been through this, cycling way ahead of all of you youngsters, this is my 4th time watching this. Yeah. And the answer is always the same. You can't pick winners and losers. So I have, and I'm going to give you the exact answer, but I have the Colin Powell view of how to answer this, which is, if you're in a war, you bring out every piece of ammunition you have, you roll it out on the tarmac, and you let the enemy look at it. And 9/10 of the time, you won't have to use it. But if you don't do that, then you're going to end up with a little war in Afghanistan. You're going to end up with a little war in Vietnam. You can't pick enough battlefronts. And that's what's happening now. So if you listen to the dialogue every day in Congress, it's a different special interest group saying, but you forgot me. So what would I do? I'd say the first thing is you need the oxygen mask to come down out of the airline and help the people who are actually not breathing. Who is that? It's the small and middle-sized enterprises who are employing most of the people. The big companies, the investment grade companies, are actually okay. They have reserves. They can still access the capital markets. They can also access the Main Street market. So at a time where we see what's happening in the well-intended employment, and I love Steve Mnuchin, in addition to being a great friend, he's one of the best Secretary of Treasuries we've ever had. But if you talk to people who are trying to get unemployment checks, it's not happening, right? The system is overwhelmed. Or people who are trying to get SBA loans, it's not happening. The system is overwhelmed. So what would I do? I'd say, how do I keep those people employed? Whatever it costs me to keep those people employed. And I'd go back to those employers and I'd say, look, for all of you that keep all of your people employed for 90% of what the last 12 months payroll was with benefits, we, the federal government, will underwrite 100% of what that is. 100%. to everybody, to those 62% of the people without picking industries. Now, why don't they do that? They don't do that because the last people that politically they want to be perceived to help is the too big to fail or the crony capitalists. Rightly so, right? So going into 2007, that was part of the problem. And what happened in 2008? In 2008, Paulson et al. Did a great job. They came up with TARP and TALF and a series of too complicated, or I'm happy to go into it with this group if you'd like. But the Fed supplied capital to the Treasury to allow the Treasury in these entities to buy securities from all of these entities to keep them alive, not only so that they could keep their employees moving, but so they could keep all the derivatives underneath them alive. AIG, Goldman Sachs. That was the good news. But the only thing worse than a crisis is a successful solution, right? Because then that's the subject of congressional investigations for 5 years. So at the end of this, people look back and said, this wasn't fair. AIG and Goldman Sachs and a bunch of private equity and alternative asset firms got benefited. The real estate guys got bailed out. But what about the little guy? What about the person with the cafe, the restaurant, the employee? What the heck happened here? So they're not going to let that happen again. But that's not what's happening here. But that is the case. So my solution is against that political odd, saying, I want to help the little guy. The big guys can last. How do you help the little guy? You force that 72% of American employers to keep their employees by saying, whatever it is, you're covered. How do you do that? You let them go to their banks. So here's the problem right now on SBA loans. The banks don't want to do these SBA loans. Why? Because it's onerous, it's time consuming. The technicality that the government supplied to it is mind-boggling, and there was no secondary market. So all of a sudden the banks go back and say, well, we understand you want us to do this, but unless you create a secondary market and buy this stuff from us, we're not going to originate it. And in one day, they went through $10 billion of this stuff without any of it being paid, right? It's difficult, which is why having the entire banking community, or on the other side, somebody like BlackRock dealing in the securities community, somebody who does this every day, right? Who's got the mechanism and the technology. And by the way, Facebook has the technology and Microsoft has the technology, and they all have the technology to reach out to those participants. But to me, maybe we're fortunate enough to live in an apartment and be able to pay the rent, but I'm living next to somebody who's not paying the rent and who's getting a forbearance for 90 days. And this is going to cause civil unrest.
Yeah, and a couple points. I mean, one, I think we all agree that no matter what plans are passed, the banks are overwhelmed right now just trying to process it all. So you do have that kind of infrastructure issue. And it seemed like you also addressed a common comment I've heard is it's this moral hazard issue that the government is basically, by bailing everybody out, the fat cats is promoting unethical behavior or maybe less than optimal behavior in terms of leverage and everything else. And I think your comments about making sure it's the little guy, however they define that, is sort of maybe the way to deal with that. But it is like sort of, it seems to a lot of folks like whack-a-mole. Okay, so last time it was the big banks, now it's, other folks. And when does it end? It's just bailout whack-a-mole, and this moral hazard problem just perpetuates no matter what we do. How do you respond to that? And one other thought, Tom, and this is where I won't get too political, but we have to all be candid. It's hard to divorce any of this discussion from politics. We all are naive not to think that. You're a staunch conservative, and I'm sure many people on this call are staunch conservatives who generally lean towards less government intervention in the capital markets. And now we're asking for something quite different. So there's a lot of criticism, and I just would love to hear, your thoughts, because we're going to have to sort of respond to those comments as you're doing through these interviews and you're writing. So just with that being said, have at it. How do you reply to some of those comments or thoughts?
Okay, anguishing. I mean, look, the political situation, number one, I'm not a staunch conservative. I'm fiscally conservative and I'm socially liberal. And I think that's how many people end up being. And look, the politics of America are so difficult, as is every country, right? I mean, if you look at what's happened of this float from globalism to protectionism, our battles in trade wars. So we're not even talking about what's happened in the oil and gas industry. Can you imagine going to $20 oil? It's not even on our top 5 things to discuss, right? It's amazing. So the bothersome part of it to me, when you talk about government regulation, and by the way, in 2007, 2008, 1989, 1990, much different consequence. The excesses of the capitalists led us to those problems. The excesses of the capitalists that were in the confines of being legal or within the regulatory confines were addressed properly by the legislature and by regulators, and those were fixed. So do you need governmental intervention to bail out a mistake in a business, whether it's an airline, whether it's an auto company, whether it's a hotel company? No. But if it's the government that steps in to cause that intervention, then the government has to have both sides of that ledger. You can't have a government taking, which is really what this is. And let's forget about the humanistics. God forbid that there's one life lost as a result of something we didn't do. So priority number one certainly is that. But the fact that you have a government imposition across the board stopping the cessation of the GDP is something that's never been seen in America. So I don't know how to respond to it politically. I'm not trying to respond to it politically. I'm as a plumber or an electrician of somebody who's just sitting in the system and begging everybody to listen up above, which is very complicated, right? They have millions of people like us, but just speaking to the real estate industry, to all of you, to all of us, the people they want to help the least is us. It's not just crony capitalists that have a bad word. When you talk about bailing out real estate other than agency debt, I'm telling you, you have 0 ears that want to listen to this. 0. And it's not fair when on the other side, it's been the government imposition, not bad management, not over leverage, not capitalism gone hooray.
Well, Tom, you've been around longer than I have. We've both been through our share of crises. I guess it's the curse of living long enough, I guess, and being in the financial markets. How do you think about timing for this stuff? So again, I heard your argument, and I think it's a persuasive one in terms of both sides of the ledger. The government created some of the issues with some of their policies, and now they've got to sort of intervene. And let's say they take your advice and they suspend some of these regulations, let's say mark-to-market accounting. How do you decide when to sort of reinstate them? And sort of, again, we don't want these to happen on a recurring basis. They seem to, just different natures. How do we sort of balance that on a more permanent basis? I get it, we're in the middle of a crisis, they step in and they do something. You and I don't want to, as much as I'm sure we're enjoying this conversation, and I hope we do it again in different contexts, you and I don't want to do this a few years from now and having these same kind of questions. So how do they sort of balance out short-term sort of changes that you think are necessary and you're persuasively arguing for, and then sort of longer term we go back to something more normal and we just don't have this dialogue again? I mean, maybe we're just not even sure. It's a tough question, and I'm not even sure we have it.
No, look, it's absolutely the right question. So look, I view it as kind of laying fiber, right? So right now, what's the beneficiary of what's happened? We've turned to digital. Colony as a company turned to digital about 2 years ago, and those digital businesses are on fire. So radio cell towers, microcells, fiber optics, data centers. But when you lay fiber, it's trauma, right? You're digging up streets, you're getting easements, so you want to calibrate the size of that fiber much bigger than what you're going to use, so that for the next 5 years, you have the ability to turn that gray fiber into hot fiber. I look at it the same way. I can't tell you how this ends because none of us know that, nor do we know that if the government now turns back the restrictions and says we're going to have testing, and those of you who want to go to work can go to work, and we're going to let the free market take care of itself. Those who want to venture into a restaurant, venture into a restaurant. It's at your own risk. And going back to our market philosophy, the market will take care of it. Some people will go, some people won't go. People like Walmart will invent a way to make that social integration more palatable, right? So that you have single lanes. All of that will happen. But if you looked at it and said, no matter what, the carnage here is going to be to your children, my children, who's going to pay the price of printing more money, right? That is the real question ultimately, and the question you're getting to. I don't know the answer to.
Yeah. Your segue was going to be my next question. I've got a couple more questions and we'll open it up. I was going to ask you, maybe change directions a little bit, and that is, what are the longer term ramifications of all the quantitative easing and whatnot? I mean, it's been my philosophy, and I've taught it, that some of the extreme valuations we had in every market, equities, real estate, bonds, was sort of the result of, 08 to some degree, and all the easing. And now, of course, we're doing more of it. I mean, what do you see, Tom, as the risk that it's again, I call it sort of shampoo stuff, wash, rinse, repeat. So we've done it, and then we're going to have, after this thing ends, and it will end, we all agree, whether it's through vaccinations or some of the things you suggested, the market returns just on its own at some point. Are we going to be, again, in another asset bubble potentially in 5 years, 6 years, and we're substituting one crisis for, again, a future one? How do you see those things shaping up, Tom, in the coming years? As best you can, knowing, again, prognostication's a dangerous business, as we both know.
It is, but I think taking your professorial lead, I agree. So what's happening is the opposite of how all of us in finance were raised to think, right? Even with a global palette and a global footprint, that productivity and growth was the ultimate solution to the economy, to our personal lives, and more importantly, to the globe. That the cooperation of hand in glove of all of us, developed countries who were hand in glove supporting developing countries, that rising tide would lift all boats. And what we found ourselves in is a quagmire of a lack of tolerance and a gigantic divide between the haves and the have-nots, which is the key problem everywhere in the world, here as well, right? That is to me the issue. And as a result, protectionism. And out of protectionism, what happens is central banks have taken the lead of politicians. So we've never lived in an environment before where central bankers are really dictating foreign policy, as you say. So what's happening is they're all in. Everybody's all in. They have every arrow of the quiver. When you get to negative rates and quantitative easing of buying your own security, you can't even explain this. You're probably the only one who can explain it to all of us, right? When you look at the circularity of what happens in all of this. And at the end of the day, when do you come off artificial support? What happens when you allow this economy to go back to balance itself is anything but good, right? Especially at a time where we're engaged in trade wars with all of our components. And I'm not saying that's wrong. I mean, at some point in time, all of our trade agreements since the Marshall Plan were utilized for foreign policy purposes, not for economic purposes. And now everything has changed. If you look at our oil business, I mean, we just get to oil independence as a heroic sign of national security. And in an afternoon, we lose our fracking business as a result of one of our allies and one of our not allies having their own priorities over our priorities. How do you solve those things? I don't know. So the global pattern is much more complicated. I'm just trying to focus and say, first, let's keep the patients alive today so that we can worry another day. And what I'm really afraid of is the people who have no access or no reach, or that don't have more than $500 in savings, are going to suffer greater than anybody thinks. And in this financial system that you and I have been crafting, this is the tip of a $700 trillion trading and derivative market all over the world. And as soon as you start having tipping balance of illiquidity clogging this plumbing and values that are being questioned, it can infect 700 trillion, not just 16 trillion of our real estate group.
All right, I only got two more for you, so because I do want to get, I know there's probably many questions coming from people listening. Just two questions. One is thoughts on state and local governments, Tom. Anything that you think that they should be doing here? I've, of course, in the real estate business, we're hearing a lot about property tax issues, and locally they're not allowing us to evict tenants, understandably balancing out compassion and fairness with economic realities, and yet we got to pay property taxes here. They're delinquent in 2 days, I guess. So thoughts about, again, what state and local governments you think ought to be doing here to help out?
Yeah, again, it's so complicated trying to pick winners and losers. So my default solution, out of a lack of intellectual integrity and how to answer that, because on the other side of that, you have the municipal bond business, right? So let's say that state and local governments say, great, you're right. I don't listen to Tom Barrack, but Professor Eric made a great point. So what we're going to do is we're going to pause, right? We're going to waive property taxes, and we're going to tack them on over a 5-year period. We're going to waive them for 180 days, let's say. So what happens is their ability then to pay municipal bonds dissipates. So the mom and the pop and the ETF holder and the 401k holder who's been relying on that to live misses that payment. So what happens is, what's happening now is the Fed says, okay, we'll open our window. We'll open the Fed window under Federal Reserve 13.3. The Treasury, in this instance, got 450 billion. Steve can lever that 10 to 1. And there's a series of collateral which can be purchased at the Fed window, in addition to what he is doing, without congressional enactment. And if they open that, they already opened it to commercial paper. If they open it to investment grade munis at that window, again, the federal government at the end of the day is going to end up paying for everything, which means we're going to end up paying for everything. But there's no way out of this. So to me, it's get it over with, make it holistic. Do it all in one fell sweep. Don't have people feeling that they're being scrutinized wrongly. And we're still going to have pain and heartache. We're still going to end up at the end of the day having the same deficit, right? Our kids, our grandkids are going to pay the price, but that's where we are.
Yeah, I have one more for you, Tom, and I'm going to change it up because let's be I don't know, proactive, positive. Someone handed you $1 billion of fresh capital today, and said, "Okay, Tom, where with all of your wisdom, experience, knowledge, what do I do? Where do you see? Look, crises bring opportunity. We both know that. What would you do, Tom? And the check's in the mail, by the way. I'll make it $1.1 billion just because you went to USC and I like you."
I would find an island that had no internet and no telecommunication, and I would wait for further information. No, in reality, look, I think obviously it's an opportune time in the real estate business when you have these mispricings, and we all say, you probably teach in your class that you buy fear and you sell greed until you get to fear, and then everybody panics. Right? So we know this is going to end, and hopefully it ends with as minimum loss of life as possible, but it's going to end. And people say, well, real estate values are going to be hard to predict because even though there's an opportunity to buy a certain asset class, all the usual food groups, who knows whether people are going to want to be entertained the way they were, or are going to want to be hoteled the way they were, or how long does it take for the multifamily business to come back to people who are comfortable getting in an elevator with each other. You know, all these things that we went through after SARS, after 9/11, we've been there before, right? And the resilience of America is amazing. But I think that these notional aspects, especially in real estate, of knee-jerk opportunities in something where there's just a cash flow impairment are dangerous. Because if you look at transaction costs going in and out of private treaty operations, it just takes too long. If you look at the securitized environment, there's tremendous opportunities. And you see it happening now, right? In the CLO business, in the CMBS business, in the whole loan business. Buying those at a discount because of forced selling is an opportunity. But I think it's acres of diamonds. To me, it's taking the things that everybody has in front of us, all the viewing audience, we all have opportunities and we all have problems. And I would start farming the things you have at hand for opportunities, including where there's debt, right? These forbearance discussions going on with every owner of a property and every lender have opportunities and detriments. And I think that's the place to start is what's the GPS on the recovery of these assets? Do cap rates come back to where they were? Is the rush on yield as much as it was, or does it go to total return? And I don't know the answer to any of those questions.
All right, well, fair enough. I'm looking for an island with no internet, so let me know if you want a JV on that. I'm in. Evan, let me turn it over to you. I know we got a lot of participants. And again, I'm grateful for everyone that's participating. I'm sure Tom feels the same way. What's heading up to the top of the list in terms of questions?
Yeah, no, great question. Thank you for all the questions, everyone. I probably received 50 questions by email, and I saw there was about 50 that came through on the Q&A, and then a number of you hit up the panelists directly. So unless Tom wants to keep doing this until he falls asleep, we can only grab a few questions. So I think we should start with the top most upvoted question on the public Q&A, and then we'll jump to a couple that came through in other ways. So that question was, most of the public traded mortgage REITs, both CMBS and RMBS, have bounced off their lows. This would suggest that the equity market no longer thinks these companies will be liquidated. Of course, there will be hits to book values, but would you also agree that we are past full panic mode?
The answer is yes. I think we are past full panic mode based on the information that we have behind us. Most of the commercial and residential mortgage REITs in the marketplace today are all well run. They have first-class management groups, they have first-class sponsorship, and even the more levered ones, the ones that you may have heard about in the last 2 weeks, were only caught because they were being conservative. So as you raise money, let's just take a commercial mortgage REIT. As you're raising money to put money out into whole loans and inventorying those like you would goods in a warehouse, you have excess capital that's not yet in those loans. So what many of them did is buy investment grade CLOs, other people's CLOs, and just hold them on their book temporarily while they're originating those loans to get enough mass to go to the securitization market. And of course, part of that scenario is their own bank revolvers and repo lines with their own banks. No one, of course, was anticipating that one afternoon it was just going to be gone. So that temporary interference, of course, caused panic because the banks, and the banks on top of these commercial mortgage REITs, who are really, the commercial mortgage REITs, by the way, are just the windows to the banks. Mm-hmm. So you don't have a mega mogul sitting here with $5 billion of capital, making loans and carving them up and keeping those returns. The beneficial owners of a REIT, right? Nobody owns more than 10% of any REIT. They're mostly mom and pops. They're broadly held. They're in essence, a contributor to excess yield over 10-year treasuries. It's the little people that own them. And so those discussions with the banks on leverage were difficult, because the banks are sitting here saying, well, I hear the Fed saying we should ease up. I hear the Secretary of Treasury saying that we should ease up. I hear POTUS saying forbearances should be a thing that we all should discuss, which is what these commercial mortgage REITs are having those discussions with their own banks. The problem is those banks have a regulatory framework of 10 regulatory agencies who have not gotten the memo. So they're sitting there, and you have somebody on a desk who's saying, look, I'm in Delaware. All I know is I'm supposed to mark this stuff to market every afternoon. I didn't get a memo from anybody else saying, save America, this is what we're going to do. So that first week was hell for everybody. And I think they've gotten through it. And with their borrowers, they're trying to do the same thing, right? You see what's happening in retail, or to assignment properties, or to the most prestigious retailers. And the same thing is happening in office on Vornado and SL Green. Everybody's having these discussions with their lenders. So my hope is that rational minds come to bear. The underwriting of most of these commercial REITs at most of the levels was conservative. Everybody now needs to find a way to allow this temporary impairment to cash flow to lapse. And that as a window to the banking business, they'll be viable for a long period to come. But that natural continuation of cash flow caused a temporary panic.
Got it. Eric, do you have a question you want to ask next, or should we hit the next?
No, look, I've asked plenty of questions. As much as, professors love to hear themselves talk. I'd rather, open up to our, people out there in the.
So here's another interesting one that came through. Tom, do you think that some FASB reform is necessary to avoid the mark-to-market issues? Just came through. You kind of touched on it early, but.
Yes. So there's two sets of things, and I hate it to probably another brilliant, accounting professor like Eric, but.
Tom, I don't know how
to his head, man.
For this, but there's the check. The $1 billion is in the mail. Just keep it. Keep the island.
But there were two. So there used to be old FASB 155 that melded into FASB 157, which basically was all of the complex fair value mark-to-market accounting. And it had a provision until 2016, which said that a bank, under certain exigent circumstances, could waive it. So what does that mean? There's mark-to-market and mark-to-model, right? So what FASB, which is its own regulating entity, in other words, it sits as a part of the regulatory framework of the SEC that's doing a great job, and the FDIC that's doing a great job, and the OCC that's doing a great job, and bank superintendents, but they're very independent. So they got rid of that provision. And what they're saying is, you guys, meaning all of you, right? Everybody's here with us, one way or the other, who's interested in real estate or somehow participating in real estate, can't have it both ways. So you say you want to be able to write up the value of these assets when you want to. So that's mark-to-market. Then when it doesn't work, you say you want to go to mark-to-model, get rid of mark-to-market, and let us take it out like the Fed does 30 years. It can't work both ways. And so their position has been, we're not waiving. These rules are intended, it didn't say only for man-made disasters. It's every kind of a disaster. So I don't think you're going to see relief from FASB on that. What has come out, which is another difficult problem, is there's another accounting methodology called CECL. And CECL was like another iteration of this mark-to-market accounting that came down from the top to banks, to the commercial mortgage REITs, to the equity REITs, that required an even more scrutinizing mark-to-market. Now, CECL at the top was relaxed. And the banks looked at it and said, well, we don't know if we want to relax it or don't want to relax it. And the regulatory intervention of everybody that's involved in it is complex, right? So what we don't have, and I hate this word, everybody hates the word czar, but if you had a regulatory czar who took finance, accounting, equity markets, regulatory markets of all kinds, and said, we're going to supersede all of this, whatever it takes for you to get through the plumbing. And it's very difficult, right? Because the capital requirements on a bank or troubled debt restructuring, right, which is a category that a bank has and has a capital charge against it. Insurance companies have the same thing. If you change that regulatory framework, you're changing the capital charge against assets. And so as what happened in the RTC area, they invented these things called capital certificates because somebody has to support the capital of the bank, right? The capital requirements of the bank are saying you have to have this much tier 1 capital. And if you violate this very technical area, you're out of capital. So what they did in the 90s is they said, pretend that you have the capital. We're going to give you a certificate. Use that as capital and pay us back when you get there. But it's really complex. So that's the long story. The short answer is I doubt whether FASB is going to move. I don't think they will.
Mm-hmm. Eric, do you have anything there on that one?
I agree. FASB doesn't work that way anyways. In my entire history of teaching accounting and dealing with FASB, and I've never heard of them doing such a thing. They spent so much time on revamping all those rules on, oh my gosh. By the way, Tom, to hear you say FASB 155 and 157, I got to tell you, I had a blood moved there. I was so excited to hear a real estate person quoting FASB. It's a little, you got to stop or buy me dinner. But I think Tom's right, ultimately. I don't see it.
The next most popular question, and maybe, it's probably our last one. So it's a little open-ended one. You've touched on it a little bit, but it is the second most upvoted, I think, currently. U-shaped or V-shaped recovery? Is it a 5-year recovery or is it short-term recovery?
I was going to ask that.
Look, I believe in the resilience of all of you and that people have short memories. It's more difficult when you're talking about life and death, but it was the same in 9/11. I remember, just as a personal experience in 9/11, that morning, I was on the Continental Airlines board and we were sitting in a board meeting at the moment that it happened, thinking this is the end. This is the end of everything. And it's certainly the end of the airline business, right? Nobody's ever going to get in an airplane again, let alone everything else that happened. And memories are short. I think the energy of the world is, and maybe out of this comes a new kind of tolerance, right? That instead of looking across borders and boundaries, which don't mean so much anymore, right? With social media, when you think about the importance of a nation versus a digital nation, everybody has communication. Everybody can see what's happening. Everybody sees the trauma that each other are in. We see what's happening in Italy. We see what's happening in Spain. We see what's happening in New York. And that empathy that comes out, I hope, builds a kind of energy that when this is over, everybody says, let's get at it. Let's get at it with more tolerance, more understanding, less fighting. Let's make America great, but let's make the world even better. So I'm voting. I don't know what it is, but I'm voting for a V.
Good. That's a good vote. Well, I think unfortunately we're out of time here, but we really appreciate you taking some time out of your day here. I know that, I apologize to the thousands of questions that we've had that don't get answered, but it's been great to have you here. So on behalf of the UCLA REAG board, the Ziman Center, George Smith Partners, and the sponsors CGS3, Horowitz, and Juniper Square, we'd just like to thank you for doing this. And, Professor Sussman, thank you to you as well for, noodling on these questions and, popping in and making an engaging and lively discussion. So We really appreciate it. Thank you to both of you.
I mean, can I finish up with one thing? And thanks.
Yeah, please go ahead.
Thanks to you for taking the sponsorship and all the viewers. I can't tell you how important it is for you to share whatever opinion you have with your congressmen and senators. Because what happens at a time like this is we have associations who all have specific points of view, who are in that lobbying business. But real estate is the heart of America, and all the real estate services around it are the impetus for every aspect of the economy that we've got. And I can't tell you how influential it is for them to hear from you directly. So what can we do? I'm always looking and saying, you know, what are the options that we have in front of us that we can exercise, and what can we control? You can control that. While you're doing everything else, whatever your point of view is, let them know, because they'll respond. So thanks everybody for your time. Thanks for the sponsorship. It was great. It's always great being interviewed by a school that wouldn't accept my application. So everybody stay safe and stay healthy.
Thanks, Tom.
Thank you. All right, guys. Thank you.